This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of September 17th, 2025. Again, Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Good morning, Patrick. An eventful couple of days, and it's interesting to see what's going on with inflation and what's happening with the markets and how that might affect a possible adjustment of the interest rate from the Bank of Canada.
Yeah, so we actually just moments ago on my morning call, we were dissecting the Canadian CPI numbers, which came in as expected, but high on the year-on-year rate at 3.1. So those are the August numbers. That's not news that the Bank of Canada is going to feel good about when they're making their decision. But consensus is that both the Federal Reserve in the U.S. and the Bank of Canada are more focused to that dual mandate, which is looking at jobs. We've been talking about it quite a bit on the podcast, how unemployment in Canada remains high, especially for young workers. But we're seeing those job numbers in the U.S. start to deteriorate. Now, on a relative basis, the U.S. looks so much better at an unemployment rate of 4.3%, but it's accelerating. And it's that accelerating speed of job deterioration, which is probably going to cause the Fed to act. And it's just going to be whether or not it's a 25 basis point cut or a really aggressive 50 basis point cut. So we're going to find out here in the next couple of days.
There was also an announcement by Prime Minister Carney about a national building project, $13 billion being focused to a number of locations where public land will be used to build 4,000 houses. Now, I have a few questions about this. First of all, 13 billion divided by 4,000 is $3.25 million. That is hardly affordable housing, for one. And the other is there any impact to Canadian equity markets with the announcement or with the program for that matter?
Well, as a joke, it sure sounds like a government project, right?
Yeah, it sure does.
Sure sounds expensive. So I wouldn't say, any market impact. So there hasn't really been any announcements out of the PM's office that have been groundbreaking for anything that we perhaps didn't know or didn't expect. And I would caution, our listeners in regards to, whether or not these events are anything that are going to move the market. And I don't think that they are. I don't think that there's anything here that's new or surprising. If we were to kind of be a little bit glass half full, I would say, for Albertans, I think what was maybe interesting last week was that Danielle Smith seemed kind of open-minded to some of the Prime Minister's projects, over the last 7 days. They're not always on the same page. Maybe again, glass half full here, we can infer here as investors that maybe the market is going to see a bit more of a focus on business opportunities, and maybe a different way of doing business. So that's maybe the refreshing tilt that we can take from these announcements, other than the fact that it's projects like this that cause gold prices to go up, because you get to get more concerned about government spending, government deficits. As of today, gold set another new all-time high.
Switching gears just a little bit for anybody who is approaching retirement or stepping on it right now, there are probably a lot of things that people just simply don't know about starting to take an income from investments. How do we get that ball rolling and start capitalizing on the savings that we've been tucking away for the last lifetime, really?
So this is going to be, I think, a great topic for us to roll out over a number of our podcasts, because there's really a lot of different ways to do this, and it all really kind of starts with each individual client and what their own situation is. So this kind of know your client and know where you're kind of coming from. Not surprising. We've got investors that are kind of all over the range when it comes to risk and what their investments look like, from the most conservative investors to the most aggressive investors, and then somewhere in between. I think one of the hardest things to do is to start to de-accumulate capital. and you think it's the easiest thing in the world to do because, we're always spending money, but to go and start to sell your assets to provide for funding, it's difficult to go and do. So, we've talked very early on about having kind of a well articulated kind of financial plan. So, kind of being able to divide your kind of your wants and your needs and be able to have an idea of what your budget is, but really being able to go and find kind of sources of passive income in your portfolio is, I think, is something that resonates for all investors, whether or not you're conservative or whether or not you're risk loving. And so, we've talked about the importance of dividends before, and we've kind of talked about the Canadian market and how there's a number of great Canadian stocks, great Canadian businesses that are really kind of rich dividend type payers. Difficult to go and really say that the passive income that you get off of a term deposit or a bond, it's really hard to get excited about that because we're looking at yields that are like 3%. And when you've got inflation that's at like 3%, is that doesn't really seem like you're really getting ahead. When we talked about dividends a couple podcasts ago, Canadian dividends on average are kind of slightly higher, and we're maybe looking at a range between 3 and 5%. But there's lots of new kind of products that are out in the market right now, which talk about higher income or enhanced income. Probably one of the most popular investments these days are these exchange traded funds that are in this group of covered calls. Covered calls are a really interesting investment in that they can be suitable for a range of investor types. So I would say there are covered calls that are designed for more conservative investors and covered calls that are designed for investors that are willing to take on more risk, more volatility, perhaps a little bit more of an uncertain long-term investment yield. But the idea here behind a covered call, and the idea covered means that you own a basket of stocks, usually in a certain sector or a certain market. So there might be Canadian dividend paying stocks or Canadian utility companies or Canadian banks or maybe US dividend payers. So you own the underlying basket. And then the provider of the exchange traded fund sets up a situation where they write calls on your behalf. And what that exactly means is they're using options to say you are providing someone else the ability to buy your stock at a higher price at some point in the future. And for selling or writing that option, you collect a fee. And the outcome could be a couple different options. Either A, the stock never reaches that higher price, so that option expires worthless. You keep the stock, or the stock rises and reaches, perhaps even exceeding that price that you were committed to selling at. And so you're then required to sell that stock at that higher price, which was probably the goal of the person that was buying that option off of you. Because what they really hoped is that you wrote an option for a stock at maybe $150 at a strike anytime out, say 90 days. The stock goes to $200, so goes above what that strike price was. The person buying that option, that was their hope. And what they wanted to do is they wanted to use a smaller amount of capital. So that person buying that option didn't want to go and outlay all the money to go and own all of the stock themselves and wait for the stock to appreciate that to that price. They wanted to control a block, maybe 100 shares of that stock at a much lower price, assuming that it was going to go up. And so most options in the market actually expire worthless. That's kind of how the options market works. And while options are relatively affordable, they can be a nice source of passive income for people that are just comfortable owning the stock long. Worst case scenario for somebody that's buying one of these covered call options is that you don't participate on the top end performance of the stock. You buy the stock, it rises in price. Maybe in these covered call ETFs, you get called out at some of these higher prices. So maybe rather than fully participating in the rise of the stock price, maybe you only get 60 to 70% of the rise in that stock price, but your dividend is enhanced significantly. Whereas the normal dividend might only be, say, 3%. Some of these covered call options can increase the dividend yield as much as to up to 4%, 5%, 6% or above. So it's one of these things where you got to know your product. You got to make sure that it fits within your investment portfolio. But I think a very innovative way for investors to go and find more yield, more income in a low interest rate market.
It's all about making your money work for you so you don't have to, and making money while you sleep.
100%.
Exactly. Thank you, Patrick. The Wealth Roundup for the week of September 17th, 2025. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns.
Thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.